Good afternoon. It is Monday, November 20th, 3:30 p.m. Stocks got about a half an hour to close. Start of a new investing week. Didn't start out too good for gold. Gold was absolutely smashed today. Gold was whatever adjective you want to use, just monkey hammered, slaughtered, ambushed. Um, they took it all away. Everything it had worked so hard to do on Friday, they very easily just took it all away. Um, I could have lived with a seven, eight, nine, $10 pullback down to the 1284, 1285 level. I would have wanted to see that, as a matter of fact. But this was totally smashed. This was uh, put back down below the key level breakout, that 1280, 1285. Um, Pushed right back down below that 100-day moving average. So this was just an in-your-face, we're taking you down. And that's what they did. There was one point, I think, they did just dump $2 billion worth of paper gold. Um, so, was this a bull trap? Was this a bull trap? I had said it had to break out one way or the other. And the initial breakout was to the upside. But quite often, that's usually the wrong move. Quite often, the first breakout is a fake out. So we have to watch this very closely now. Because so often the knee-jerk reaction to news is it goes up, and that's the knee-jerk, but it's the wrong move, and it goes back down. Or vice versa, it goes down, knee-jerk reaction, and that's the wrong, and then it goes up. So was this breakout out of the range, was this a fake out? It's very possible, the way they just manhandled gold today. So we have to wait and see. But stocks, to be honest, they're not doing all that much. Dow Jones is up about 65 points with a half an hour to go. Bond market is quiet. But I've been doing a lot of thinking this weekend. There was an article that I read last Thursday and just didn't even get a chance to talk about with everything else that was going on. And that was the San Francisco Fed, John Williams. And he said some things that are pretty pretty scary, right? Because as you know, Janet Yellen is not going to be around much longer. And Jerome Powell will be taking over soon. So are they going to take the Fed in yet another direction? Are they going to now double down? Global central bankers should take this moment of relative economic calm to rethink their approach to monetary policy. San Francisco Fed President John Williams said Thursday, warning that to fight the next recession, as with the last, they would need to do more than just cut interest rates. So in the last recession, the Great Recession, right, which some people still think that we're in, they cut interest rate practically to zero, right? They did how many rounds of QE? 3 rounds of QE in Operation Twist. But that wasn't enough. The next recession, we're going to have to do more. Do you see where this is going? Do you see where this is going? So I'm really not perturbed about today's move in gold. We've seen it before, okay? It doesn't surprise any of us. And I read comments and articles and look at other videos and you get a sense that just people are resigned that it's just going to be this way, because this is how it's been. And there's that, what could be that recency bias, this is how it is, so this is how it always will be. But I've been looking this weekend and I've been researching, and I've been thinking of some things, because a lot of people, they're looking for a blue swan, or a black swan, I should say, excuse me. But I'm not. I'm looking for indicators that will come out surface months before the actual event. And history is always a good guide. So I've been going back and I've been reading about the Great Recession, the credit crisis, the financial crisis of 2008 and 9. And I've been reading about Weimar Germany. And I'm looking for indicators to see if what happened then is starting to happen now. So I'm not looking for some black swan. I'm looking for these indicators that are just the start. Other Fed officials, including Chicago Fed Bank President Charles Evans, have in recent days urged a strategy review at the Fed. But Williams's call for a worldwide review is considerably more ambitious. A worldwide review. With many major economies facing slower growth and thus lower interest rates, even when unemployment is low, central banks will need to find ways to stimulate their economies that work even when many other countries are also trying to boost their growth. Did you catch that? So it's even while other countries are trying to stimulate and boost their growth, central banks will need to find ways to stimulate their own economies. We can't all grow together. I already said everybody's up to here. Okay, we're all stuffed. There's no more debt. This system needs an ever-increasing amount of debt. That's the only way out. Okay? I mean, this is Thanksgiving week. Okay? And when you think of Thanksgiving, what's the one thing you think of besides turkey? Right? Overindulgence. It's one of these, not one, but it's another time of the year when Americans overindulge. They eat too much. And that's where we're at here with the debt. And these are the indicators that I'm really looking at. We will all be better able to contain the next economic recession if we develop approaches that succeed even when many countries are simultaneously constrained by the lower bound, Williams said at the opening of a 2-day conference on Asian economic policies at the San Francisco Fed. And that means taking into account the nature of monetary policy spillovers. Other Fed officials, including Chicago Fed Bank President Charlie Evans, had in recent days urged a strategy review at the Fed, but Williams' call for a worldwide review is considerably more ambitious. All right, kind of repeated that sentence. We will all be better able to contain the next economic recession if we develop approaches that succeed even when countries are simultaneously constrained by the lower bound. This includes negative interest rates. Negative interest rates. If he's saying it, they're considering it, and they'll take it there. Price targeting. So their 2% inflation target, maybe that's not high enough. Maybe we have to go to 4%. Nominal income. So perhaps everybody will make a certain salary that the deep state will deem, appropriate, whatever that might be, 25,000 a year. That should be sufficient. You're a family of 4, let's say, 25,000, 28.5 we'll give you. Family of 4, okay? That'll cover the cost of your housing, your food, okay, your car. This is where it's going. This is what he just said it right here. Negative interest rates, price targeting, okay, income. So I don't care about the stock market. Up until now, I said I was bullish. This time it's different. I'm starting to see some cracks, and I see where this is going. So I was looking at this Venezuela, because Venezuela, I mean, they're done. They're toast. And I look back at Bear Stearns. Everybody wants to remember the Lehman moment, that Lehman moment. And I remember that Sunday night I was watching the price of gold, and gold was going up and up and up. And it had been in a bull market. And then it just got hit. And it seemed awfully bizarre to me at the time, because that was not the typical price action. Not like today, being in a bear market, the way it gets hit all the time. Back then, when it was in a bull market, you weren't seeing that, and that was awfully strange that night. And the next morning, you woke up to Lehman. But before that, Bear Stearns was in trouble, right? All the way back in June of 2007, they had needed to borrow some money, a bad loan, this and that. But the key indicator that I saw, the credit default swaps, the spreads on the CDSs were going up. They were going up. The credit default swap, basically in an insurance policy, okay? Right? I want to buy protection, right? So I buy a CDS from you, and I have to pay you a premium, a fee, quarterly, all right, in case the loan defaults, right? I'm buying protection. The seller of the CDS, right, they're taking in the premium, they're taking in the fee. If the loan were to default, well, they have to pay the buyer the loan, right? So that cost, that's the spread, and it was going up. Something was signaling there were problems. Now, is it the chicken and the egg? What came first, the chicken and the egg? Were these increasing spreads creating a sense that something was wrong with Bear Stearns, and so it's like a self-fulfilling prophecy, which causes them to go down more and be in more and more trouble, right? Because now that their capitalization is in trouble. Or was it the fact that they were in trouble that was increasing the spreads? Okay? I think it was the latter. They made bad loans, okay? They had all these derivatives, okay? They were bleeding. They were overexposed. And the CDSs started to show that. More and more people, okay, wanted more money, okay? If they wanted protection, they had to pay more money. I'm seeing that here. I'm seeing it here with these credit default swap spreads, which are increasing. Venezuela might just be the tip of the iceberg, okay? Back in 08 and 09, right? Prior to that, Iceland, the tiny country of Iceland, right? They got into trouble. Their banks were like, they borrowed 10 times more than their whole country's GDP. 10 times more. Deregulation, right? Leverage. I see it here all over again. It seems to me like it's starting. So I'm not going to get sidetracked. I'm going to focus on these indicators. And this is what I want to study. And this is what I want to research. So we'll see what happens with this gold. If it can bounce back here. If this was a bull trap, we'll see. I don't know. Tomorrow I think is an important day though. If we can kind of recover some of these losses. So that's about it for now. But I'm not gonna get sucked into all the noise. I'm not gonna do it. So anyway, it's a beautiful day out there. Really gorgeous day. If you can get out, take a walk, enjoy the fresh air, stretch your legs. Pick it up tomorrow, Lord willing. Ciao.